Have you ever wondered why our economies look the way they do today? A huge part of the answer lies in the ghosts of crises past. Today, we're taking a deep dive into how major financial meltdowns have fundamentally reshaped our modern economic landscape. This isn't just a history lesson, it's the story of how we got here. Let's travel back in time. Think of the Great Depression in the 1930s. It wasn't just a stock market crash. It was a decade-long economic winter that left millions jobless and desperate. The sheer scale of this disaster forced a radical rethinking of the government's role in the economy. Before this, the prevailing idea was laissez-faire, or let it be. The market would correct itself, they said, but it didn't. In response, governments, particularly in the United States, introduced groundbreaking policies. We saw the birth of social safety nets like Social Security. Banking regulations like the Glass-Steagall Act were created to separate commercial and investment banking, aiming to prevent the risky behaviors that led to the crash. This was a monumental shift. The idea that the government had a duty to intervene to ensure economic stability and protect its citizens became a cornerstone of modern economics. Central banks also learned crucial lessons about providing liquidity to prevent bank runs from spiraling out of control. Fast forward a few decades to the 1970s and the oil crisis. This wasn't a banking crisis, but an economic shock that sent inflation soaring and growth plummeting, a nasty combination known as stagflation. For years, the dominant economic theory couldn't explain or solve this problem. This crisis discredited some existing models and paved the way for new ideas, particularly those emphasizing monetary policy and the control of the money supply to fight inflation. Central banks, like the U.S. Federal Reserve under Paul Volcker, took aggressive and often painful steps to rein in prices. This established the credibility of independent central banks as inflation fighters, a role they still hold today. The world also realized its deep dependence on oil, sparking a global push for energy diversification and efficiency that continues to shape geopolitics and technology. Now let's talk about a crisis many of us remember vividly, the 2008 global financial crisis. It started in the U.S. housing market, with subprime mortgages, but quickly spread like wildfire through the interconnected global financial system. Banks that were considered too big to fail were suddenly on the brink of collapse. The world held its breath as Lehman Brothers, a 158-year-old investment bank, went bankrupt. The 2008 crisis was a brutal wake-up call. It exposed massive vulnerabilities in a system that had become increasingly complex and deregulated. The financial instruments being traded, like mortgage-backed securities and credit default swaps, were so complicated that even many of the people selling them didn't fully understand the risks involved. The aftermath was a flurry of activity. Governments and central banks launched unprecedented rescue missions. They injected trillions of dollars into the financial system through bailouts and quantitative easing to prevent a complete collapse. But the response didn't stop there. The crisis triggered the most significant overhaul of financial regulation since the Great Depression. In the U.S., the Dodd-Frank Act was passed. It created new agencies to protect consumers, increased the amount of capital banks must hold to absorb losses, and attempted to shine a light on the shadowy corners of the financial market. Globally, regulators coordinated through bodies like the Basel Committee to create stricter international standards for banks. The concept of too big to fail was directly addressed with new rules designed to allow large, complex financial institutions to be wound down in an orderly way without bringing down the entire system. These policy responses are absolutely crucial. Without them, a financial crisis can turn into a long-lasting depression. The goal is twofold. First, stabilize the system in the short term, stop the bleeding. This involves providing liquidity, guaranteeing deposits, and sometimes taking over failing institutions. Second, address the root causes to prevent a repeat performance. This means regulation, oversight, and sometimes fundamental structural changes. The 2008 crisis also had a profound impact on monetary policy. With interest rates already near zero, central banks had to get creative. They started using unconventional tools like quantitative easing, buying massive amounts of government bonds and other assets to push down long-term interest rates and encourage lending and investment. These tools, once considered radical, are now a standard part of the central banker's toolkit, used again during the recent pandemic-induced economic shock. But the story doesn't end with regulations and monetary policy. Financial crises reshape society in deeper ways. They fuel public anger and distrust in institutions, both financial and political. They can lead to populist movements and significant political shifts. The 2008 crisis, for example, is often cited as a contributing factor to the rise of political movements on both the left and right that challenged the economic status quo. Crises also accelerate long-term trends. The dot-com bust of the early 2000s, for instance, wiped out many frivolous internet companies, but it also cleared the way for these stronger, more resilient tech giants like Google and Amazon to thrive. It forced the tech industry to focus on viable business models rather than just hype. Looking at the Asian financial crisis in 1997, we see another example. Countries like South Korea and Thailand were hit hard, partly because they had borrowed heavily in foreign currencies. When their own currencies collapsed, their debts became impossible to repay. In the aftermath, many of these nations learned a painful lesson. They built up massive foreign currency reserves to protect themselves from future shocks, a strategy that has changed global capital flows ever since. So what's the big takeaway? Financial crises are like economic earthquakes. They are destructive and terrifying, but they also reveal the fault lines in our systems. They force us to rebuild on stronger foundations. The regulations we have, the tools our central banks use, and even the political conversations we have are all, in large part, a direct response to past failures. From the ashes of the Great Depression rose the modern social safety net. From the inferno of 1970 stagflation came the era of independent inflation-fighting central banks. And from the rubble of 2008 emerged a more resilient, if not perfect, global financial system. Each crisis is a chapter in the ongoing story of our economy. They serve as painful but powerful catalysts for change, forcing us to adapt, innovate, and hopefully learn. Understanding this history isn't just about looking backward, it's about understanding the world we live in right now and being better prepared for the challenges of tomorrow. Thanks for watching. If you found this deep dive interesting, don't forget to like this video, subscribe to the channel, and hit that notification bell so you don't miss our next exploration. Let me know in the comments which financial crisis you think was the most transformative. See you next time.